Hey everyone, Cathie Wood is dumping shares of Shopify stock into the market hand over fist. So in this video, I'm going to take a look at Shopify stock. I'm going to take a look at the e-commerce industry. I'm going to look at Shopify's valuation, and I'm going to look at why I think Cathie Wood is selling Shopify stock and whether or not you should sell Shopify stock as well. So let's get right into it.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So on December 1st, Cathie Wood sold 85,000 shares of Shopify stock, but that was not the only sale of Shopify stock in her recent transactions. If we look further, Cathie Wood also sold 8,000 shares of Shopify stock on November 30th. And if we go further, she sold 49,000 shares of Shopify stock in November 29th. So why is Cathie Wood selling so many shares of Shopify stock? Well, one reason could be that Shopify stock price is already up 109% on the year. That's an incredible gain for an entire year. And so she might be just taking gains and saying, let's take shares of let's take these gains, take that money and put it into something else that could potentially grow much faster than Shopify stock because it's already up so much in 2023. Now, Shopify stock has benefited from the rebound in e-commerce spending, and the industry is poised for growth in the long term. Let me show you this next metric. So, according to Statista, the revenue in the e-commerce market in the United States is forecast to continuously increase between 2023 and 2027 by a total of $490 billion, an increase of 53%. After the 10th consecutive increase in year, it's estimated to reach $1.4 trillion in 2027. So the industry overall is growing quickly, and you can understand why. It's just so much more convenient to shop online instead of shopping in person. Things are delivered to your doorstep, and typically you can get free shipping. And so it's not surprising that the e-commerce industry will grow over the next several years to become a greater share of people's overall spending. And Shopify is gaining market share in that industry. Shopify is gaining market share. Of course, the dominant player in e-commerce is Amazon, but Shopify is steadily making progress. If we look at Shopify's latest quarterly results, there's a lot of things to consider. So let me highlight the big picture items that I saw from Shopify's latest quarterly update. Number one, revenue was up by 25% in the third quarter, and gross profit increased 36% year over year. Free cash flow turned positive for the fourth consecutive quarter, reaching 16% of revenue. Those are all excellent figures, but there is some caveats to that. Let's look further into Shopify's quarterly results. Shopify's operating income came in at $122 million, or 7% of revenue. That was compared to an operating loss of $346 million, or 25% of revenue for the year ago period. Free cash flow came in at $276 million, or a free cash flow margin of 16% compared to negative free cash flow of $148 million. So when you take a look at these year-over-year growth rates, you get the idea that Shopify made some phenomenal improvement year over year, but that's not really the case. The story behind Shopify is that it divested its logistic business. This was a business that Shopify had invested nearly $4 billion into. And after a short period, Shopify gave up on it and said, this isn't working. It's costing too much money. It's too capital intensive, and we want to divest away from it. And so they sold that logistics business in a few quarters ago. And so because of that sale, Shopify's results look better year over year, because last year, those figures were included in Shopify's results. That's why they were losing so much money on the bottom line, because of investments in that logistic business, which is categorically, fundamentally, a lower profit business overall. The logistic business is capital intensive. offers lower profit margins if you look at comparisons. Like if you look at Amazon's e-commerce segment, that segment offers very low profit margins, less than 10% for Amazon's business. And Amazon has spent hundreds of billions of dollars building that out. So you can imagine Shopify with an investment of less than $10 billion cannot compete with the likes of Amazon to reach that kind of profit margin. And so even though Amazon's profit margins was not great, Shopify's was going to be inevitably worse than that because it hadn't put in that kind of scale that Amazon had put in. And so when Shopify made that announcement initially, a few years ago when it was going to invest in the logistics business, that's when I got turned off from Shopify stock. Up until that point, when it made the announcement to invest in logistics, I had Shopify stock rated as a buy, but as soon as it made that choice to invest in logistics, I did not like that direction and I downgraded my rating for Shopify stock, and I've kept my rating downgraded to a hold for Shopify stock. I hadn't recommended Shopify stock as a buy ever since then. So that investment, that blunder, as I like to call it, is why many investors have been turned off from Shopify stock. And it could be one reason why Cathie Wood is selling Shopify stock right now. Although I don't think that's likely a cause, because she would have sold it much earlier if that was the cause when that announcement was made. The fact that she's selling shares now makes me believe more so that she's just taking profits because the stock is up so much already. But let's continue. So management thinks that for the rest of the year, full year revenue will grow at the mid-20s% rate year over year, and the fourth quarter gross margin percentage will be over 300 to 400 basis points higher. And even management is admitting that it's primarily due to the absence of the logistics business. It's primarily due to the absence of logistics business. So this improvement in performance was not an organic improvement in performance. It was just because it split off a part of the business that wasn't performing well, and that made the overall business performance look better, right? It brought it back to where it was before it made these investments to begin with. And so it's just, it was doing really well before it made these billion-dollar investments in logistics, and now it's trying to find its way back to where it was performing excellently before it made this, in my opinion, mistaken investment in logistics. So now I want to show you where this shows up on Shopify's income statements, because it's no longer showing up on Shopify's revenue and cost, because it doesn't operate the logistics business. But when it sold the logistics business, it retained a significant percentage of ownership, right? It owns a piece of the business that now owns the logistics business of Shopify, if that makes sense, right? It sold it partly for cash and partly for stock. And so now if you look at Shopify's balance sheet as of September 30th, you could see equity and other investments carried at fair value, $2.852 billion in equity investments. That was up from $1.94 billion as of December 31st. And if you go further back, it's up even more. This whole $2.8 billion is that piece of that logistics business that Shopify sold off, and it now owns that much value in the logistics business. So you're going to see Shopify report changes in the value of its equity and other investments. So this value is going to go up and down every quarter based on the fair value of that investment, of that ownership stake in that other company. So Shopify hasn't totally divested away from that business. It just took it off of its own balance sheet, took it off of its own operations, and transferred it over to the company that it sold it to. It did get some cash. Let me show you that. So here, if you look at the acquisition of businesses net of cash acquired, in the year ago period, you can see here a negative $1.72 billion in cash here. And since this is acquisition, a negative figure in the acquisition means that it was a divestiture. So it sold that and it got the $1.72 billion in cash. So Shopify received $1.72 billion in cash for its logistic business, plus a couple $1 billion worth in shares of ownership of the company that it sold it to. So it was a kind of a half and half stock, half cash sale. And so you can already see the impacts of that divestiture starting to play a factor in Shopify's results, but still it's going to disrupt the business in terms of the income and the change in equity value going forward. Finally, let's take a look at Shopify's valuation. Shopify stock is trading at a price to free cash flow of 170. It is expensive. It is very expensive. And so the stock is already up so much in value for the year. It's got that factor going forward where it's going to impact the revenue, it's going to impact the equity value of the sale. And so those factors I can understand. I can see why Cathie Wood is selling Shopify stock. If you own Shopify stock, I don't know that I would say you should sell it too, but I wouldn't be buying Shopify stock at these valuations. I think it's too expensive to buy right now, and that's what I have Shopify stock rated as a hold. If you liked the video you just saw and you want to see more just like it, please subscribe to the channel. I can't keep this channel free without the support of viewers like you. And if you're already subscribed, thank you, and I appreciate your support.